This is going to be a video that summarizes one of my classes now. I've been struggling and putting together online classes, and I hope they're okay. I really do. Um, at the end of the class, I say, I'm going to make a video to summarize this class. And this is a summary of a class about an M&A. It's a merger and acquisition. And it really has a lot of kind of valuation analysis in it. Okay. And what I'm going to do is I'm going to walk through a little bit of uh, uh, the spreadsheet we put together in the class because I promised to do this for the delightful students who attended the class. And then I'm going to, at the same time, try to discuss some of my ideas. Now, I tried to put some of my ideas on for this online class for this M&A in my video, and I've been in my website, and I've been struggling with kind of trying to get this all right too. That's why I haven't had time to do some. So this is our M&A, and I put a separate sheet for M&A theory and analysis. I'm going to do this, and just to summarize some of the big key points I want to make is, or I hope to make, are, well, is I'm going to go through some alternative valuation techniques and ways to evaluate M&A transaction. But please, if you're the title of this should be really valuation, and a little bit of M&A. I don't care about M&A and getting the fees on the M&A. I care about some of the modeling. And we'll talk about different ways to value the M&A and go through some models. And then we'll talk about corporate model and using things like the thing that really bothers me, and I'm going to try to explain it in an easy way, this correcting the terminal value uh, compared to the way people typically use it. And I think I found that people really do typically use it kind of in a horrible way. And then we're going to talk about another method people use in M&A, and that's using multiples, and particularly the EV to Ebitda ratio. And I thought this was so obvious. And I'll explain why I don't think it's that obvious now. I think people kind of do this thing where you make a comparative set of companies, and you call them comparables, and you have a transaction comparable. And I want to show you how you can do this in a much more reasonable way by adjusting the EV to EBITDA ratio for things like the lifetime of the assets, the trends in the return on invested capital, the growth rates, the tax rates. All of these things should really be considered when you're comparing one to another. I'll try to explain that. And then I go kind of crazy. In M&A, there's this whole business of unleveraging and releveraging the beta and using cost of capital. Of course, I go completely wild about how the cost of capital really should work. And then finally, I'll talk about some what I consider idiotic adjustments, where you have an EV to EBITDA ratio and you adjust it for a small company or a private company versus a publicly listed company. These arbitrary adjustments that sound so sophisticated, and I used to be all enamored with. And I'm going to restate some of this. I call this avoiding magic potion. Here's my little magic potion. I say, if you just compute EV to EBITDA like everybody does without adjusting for the asset life, oh, you're believing the magic potion. If you estimate synergies in a merger with using the normal kind of weighted average cost of capital that you would use for the company, the company itself, it's a dangerous thing to do. If you don't normalize cash flow in the terminal year, especially when you're computing the Gordon's growth method, it's crazy. If you calculate cap M with a 5.5% or 6% risk premium. It's nuts. If you just apply the wonderful growth rate method, 1 minus G over ROIC divided by WACC minus G, without adjusting it and using a little bit of interpolation, you're going to get a crazy answer. These are all beliefs. Applying all of these are believing in the magic potion. If you believe somehow that a company, when you go from the explicit period to the terminal period, will magically all of a sudden at one single time become in this wonderful equilibrium state, it's just magic potion. And I've already talked about the risks and other things. And so I'm going to also moan. I hope you don't get mad at me, but I'm going to moan about applying bureaucratic kind of ways instead of creating. Modeling can be such a creative, wonderful thing, but if you automatically always apply a 5-year growth period, Gordon's growth model, if you don't explicitly consider rate of return at every stage of the analysis, if you use EV to Ebitda ratios without making adjustments, if you don't consider strategic what you're doing when you're really measuring synergies, if you unlever and relever the beta without making adjustments for the debt beta, if you use this, you're all applying this bureaucratic stuff that just gives you nonsense. So you know what I'm going to do. You don't know. There's this article that my friend Conan gave me. He's from Indonesia. He gave me this article about when some two Lilia and Kejil Nyborg, I don't know if I pronounced the name right, but they did a study of what methods people actually use, and it's really pretty sad. They really do use such simplistic methods, and I'll refer to that a little bit. Now, so the first thing I'm going to do, let me just now skip through. I'm going to talk about alternative methods and why you'd use a football field diagram as a framework for thinking about stuff, and then we'll use kind of talk about general valuation, and without talking about general valuation issues, and in particular the return that you're going to make in project finance. The other thing I deal with, everybody talks about return all the time, return IRRs all the time. And then you go to corporate finance and people are talking about terminal values and growth rates. And what I'm going to emphasize is that we can have a lot of these valuation approaches are geared to really boring old companies with stable kind of growth rates and a lot of history, and not tricky situations where you could have a startup company, you could have a software company that doesn't spend, didn't make much investment, you could have our returns that change dramatically over time, you could have a lot of things. And I used to be like this too. I used to see all these people in the year 2000. They used to talk about the new economy and options and real options and all that. And I thought it was so silly. It's not that silly anymore when you look at companies like Amazon. And what we'll talk about is, and I was going to go through this quickly, and I'm not. But I'm going to put all of the PowerPoint slides up here and the Excel exercises that go along with this up here. So I'm blabbering on, and you can turn the video off whenever you want. Now, this is the classic kind of diagram from some consultant, some fancy consultant with those beautiful arrows that go around, almost like a circular reference. But the one point it does make, ultimately, when you're going to do any valuation, so here's what I say. Before we start with a DCF, accretion dilution, LBO method, anything else, think economic value of synergies. Before I go through all of these methods, think about what valuation really does. Think about that it's all from getting a return and trying to get a decent return. That's why in the summary page, I typically try to show some growth and returns, and next to that, some cost of capitals and different valuations. And this is a really boring food company. Okay? It's not bad to be boring. Remember, it's really good to be boring. So what this says is if we can figure out something that's really good, if we can beat our competition or something, if we have some good cost strategy, if we have some differentiation of our product, if we have some monopoly power, if we're not just getting into a commodity business, which isn't bad to do as long as you can keep your costs low, if you can do something very special and keep it up, which is really hard to do, then one day you can get a return on investment that's really pretty good. And that return on investment might not come for years and years. You might be like Amazon. Amazon, what a great study that is. They were making a crappy return on investment so many years, but they were growing. And everybody thought, what an idiotic investment. You're going to grow and make a lower return than your growth. You're throwing good money after bad money. But no, that's not what happened because eventually the return on investment goes up. And if you think you can always do something like this and assume the return on investment is always the same, you're an idiot for the valuation is just so boring. You have to figure out what's going to happen and can it continue to get kind of monopoly profits or people addicted to their stuff or whatever you have to get that ROI high? And then you're supposed to compare that to the cost of capital, whatever that is. That's this amorphous kind of term that most people can't even define because it's the minimum rate of return on an alternative investment with a similar risk. And to claim that there's a wonderful quote from Taleb who says this is like selling some kind of potion for some kind of cure on the internet. Now, once you get all of this statistics, but not one time over a long time, then you get your valuation. Now, this reason I'm kind of going through this is in M&A, you better be thinking about valuation, all the ROI and growth all the time. And my son, he took some class at, well, I could say in this booth thing. And, he took some private equity class, and there were all these young bankers who thought they were so smart and all that stuff. And they didn't, I looked in all his slides, I looked over everything to see if they mentioned the word return on investment. I couldn't even find that word in all the Harvard case studies and everything else he used. I couldn't find this. And when we really thinking about what we're going to do, so this is again a long review, and it might be kind of boring for you, and you can turn it off. But I'm not going to feel bad about making a long video right now. I'm sorry. So this is this classic consultant valuation. You want to be here where you get a good return and high growth. It's an interesting way to think about things. And I put this one, I put what you're doing here. This is what the consultants call it. They don't call it throwing money away, but this is the worst place to be. Making a low return and spending a whole lot of money on it. One of the basic things about business is you know when to stop. You know when to get out of it. It's a hard thing to do to stop a business and get out of it when all your emotion and everything else is invested in it. This is a better place to be than this because at least when you're not making any money, you're getting out of the business, exiting business. I hope I wrote that down. And this is a nice place to be. This is a boring company. I should restate this and put boring company. It's almost sometimes nicer to be here than here, especially because the weighted average cost of capital might be less than this, which is so hard to actually really, really compute. Now, when we're in this when if you think about M&A in this one, if you're buying an existing company, what you would love to do is take an existing company that may be here and you would like to get it to move over here. The problem is too many of these companies, everybody enters the business and they move over here. And when you think about this in a more dynamic way, that could be interesting. When maybe you have a cash cow and you delude yourself into believing that you can take this company that's earning a pretty good return and push it up over here. Okay. Yep. And then maybe the best thing to do is, if you're right here, maybe you want to exit the business and increase the value by exiting the business. That's what you really want to, before we do all of this valuation, we want to think through just a little bit to think about what's really happening. Okay, and here's a simple rule that I do agree with. If you're going to be an M&A and you think you're going to really improve the operation of a company, if you think you're going to improve the operation of a company, you can do it in the context of this. But if you think you're going to, I should have made this larger, I think. Here's the simple rule. You should be in the same industry. You think you can increase returns, you can increase growth, you know when to exit the business, all of this stuff in a company that's not in your industry. What a fool you would be. So you should be in the same industry. And then if this target company is already here, that means you're just going to be paying a lot for a company that's already there. And that, when you pay a whole lot for this company, it's probably going to go down here or down here or down here. That's the first thing. And that, so when it's already there, do that. Or you want to buy a company that's maybe over here. And then you want to buy a company maybe that's over here so you can increase the growth or you can increase the return if you really believe you can do that. And that's the whole business of M&A is taking over. And now I spent a whole lot of time, and I should show you where this is. I spent a whole lot of time doing a simulation of, I did like some stupid little kind of random thing. I'm not going to call it Monte Carlo simulation, although the best use of Monte Carlo simulation really is demonstrating things more than actually in valuation. And here I said, here I kind of put different growth rates in, different returns, different, and I kept the cost of capital the same, I think. And you can see which ones resulted. So it was much best here. You got really high growth. No, here high return and some growth. Okay, right. If you got no growth, and even if you get a high return over here, this is where the value really explodes. This is your Amazon. Okay, you're growing, and well, that's not quite true. They didn't get a high return now, but they're starting to get a high return. How high and how it can be maintained is really the big issue. If you get a low return, you're here. If you earn less than your cost of capital, these numbers are negative. This is the worst place to be. These numbers are tiny. These numbers are tiny. It's all about making a return, getting a monopoly profit somehow, getting people addicted to your product, having a low cost structure, doing something here along this return line. And then it helps to have high growth, of course, but it's really that return that seems to be driving it more than anything else. It's the way I defined the X scale and the scales, of course, too. So the very first method we'll use, and we'll put this method, I kind of went through this whole football field diagram very quickly. That the nice way to, the reason that football field diagram might be a good way to start thinking about these things is because you have different values. You don't know exactly what the value is. Don't delude yourself into thinking you know an exact value. What an idiotic thing that would be. And also, don't be all obsessed with one technique versus another technique. So there are different techniques. That's what's nice. And then there are different values. Now, when in the scenarios and graphs, I have a football field diagram there. So why don't I go there just for a minute? So the way I try to do this is then you can go down, and I think there's a video, and I even took some of the stuff. Did I put the video here? Oops, I didn't put the video there. I will one day, maybe tomorrow. Okay, so we're back to this one. So that's our football field diagram as a way to think about the class. And whenever I talk about valuation nowadays, I love more than anything to get in and start moaning about these idiot bureaucratic rules using these Gordon's model. And Gordon, by the way, he used to testify in utility rate cases, and I bought his book in the 1970s probably or 80s, and it's a tiny little book and it says nothing. All he was trying to do was increase your electricity bill by claiming the cost of capital was higher, and he used a simple something simple to get that. So I love to get into moaning about this, but this time I'm going to try to be a little more structured, and perhaps I'm not. Perhaps I'm not. And I want to tell you in valuation, I want to kind of explain, and you can get this, if you study project finance, maybe I tried to say I'm going to be really structured, and I'm not. If you study project finance, you can see that during the development stage of a project, everything's about probability, development cost. Can we get a successful project? It's like in this pandemic thing. Can we get a vaccine that's successful or not? Then we can, once we can get something really successful, then we have a gigantic payoff. The valuation of a company in an early stage, in a startup stage, in a development stage, cannot be anything like valuing an old boring company like FedEx or somebody like that, or even Microsoft, or all these companies that have been around forever and have they might have some really good financial performance or bad financial performance, but they're basically going to earn a return every year, and you're going to earn a return that can be computed, and it's pretty easy compared to these new situations. And the reason I just mentioned that again is that the first rule of M&A should be measuring the benefits of a merger by comparing the net present value of synergies, which is a horrible, stupid name, with the net present value of the premium you pay. Okay. And here is what I really want to say. Some synergies, like firing people, they might be very low risk. They might have a cost of capital and a risk assessment that's lower than the WACC. Other synergies, like I'm going to use a new marketing method, and I'm going to put together two different products, and I'm going to do XYZ and change the whole strategy and the management of the company around. They might have they might be enormously risky, like our startup companies, because you're almost starting a new business with this new company, and will it work or will it not work? And trying to apply the same kind of simplistic discount rate to all of the synergies would be idiotic. Again, the do I have here's what I'm going to do. I'm going to now open this file. So on this particular page of the website, uh, I'm going to put a PowerPoint. Okay, and this this file that I'm going to open, okay, is not my project finance file. It is my corporate analysis file. Okay. Oh, welcome back. Okay, and I've got very similar kind of slides here, but I'm going to skip to our very first method, and then I'm also going to be opening, here's an example of some real football field diagrams, a little more detail on some of the things we've talked about, uh, and here's a wonderful merger between Monsanto and Bayer. Can you imagine those poor investors in Bayer? Oh my God, with all this lawsuits, I have no idea what's happened to that, but I couldn't imagine it not being a disaster. Okay. And I talk about the method number one, which is evaluation of synergies and premiums. So we're going to talk about this method. That's number one. Method number two. That's going to be accretion and dilution analysis. No DCF in either of these. Well, there is in the first one a little bit. Method number 3 is going to be fixing the EV. No, method number 3 is going to be the implied value from a leveraged buyout. Method number 4 is going to be the EV to Ebitda ratio, and see how we fix the EV to Ebitda ratio, and careful with that. Method number 5, finally, will be the DCF method, and how we can take this DCF and start adding things and subtracting things. Now, this is here I made this little chart. And in this chart, I say, look, if you go into the bar, and you say, okay, I'm going to go into the bar, and the cost of beer here, did I put the cost of beer here? Oh no, I couldn't see the cost of beer. The cost of beer, whatever it is, I'm going to go into the bar, and they say the cost of beer is unos, I don't know what it is, €3, €5, whatever. I'm going to offer to pay 20% more. Why would you ever go to a bar, and if they say, here's the price, you say, no, I want to pay more. But that's a premium. That's what a premium in a merger is. So the very first thing we really have to do is understand what some of the M&A terms, and once we understand those M&A terms, then we can start to analyze them. Get some words out. So you go to a bar. Now you maybe you go to a bar and you say, okay, whatever, let's take this beer. I don't know what, okay, I don't even know what this stuff is. I bet you it's really good. I'm going to take this beer, and sounds bad. I'm going to put some nice little adder to that beer, some flavor, some flavor into that beer, and then whatever, maybe some lemon. Who knows? I don't know what you do. This might be an idiotic example, but you do something to that beer, and then you can sell it to all these people for a lot more. So you're going to buy all the beer, fix it up. Don't put anything bad in there. Don't put anything bad in there. I'm not talking about putting bad drugs in there. Please don't put me in jail or anything else. I'm just saying you're going to do this. You're going to buy all the beer. And to buy all the beer, you want to make sure it doesn't go anywhere else. So then you're going to pay more. So you're going to change something. The idea is that you're going to change something. It's not going to be the same. That's the idea. And is the value you're going to get from changing the beer more than the extra payment you made to get all the beer in the whole bar? What a silly example. I have to come up with a better example than that. Okay, and so we have to recognize first, and this is the bureaucracy. This is my fight. My fight in when I used to fight against utility companies, I used to yell at them for being bureaucratic. Oh, I used to fight all the time. And I want you to think creatively. And if you have to recognize that changing a management strategy is not the same as the risk of the overall company. Changing a strategy might have less risk. It's like that difference between a boring company and a simple company. So I think I'm going to skip this. Here's some chart somebody gave me. I have no idea. I can't really remember this one. The okay. Shoot. Okay. They said, oh, here's when you have one of these acquisitions, we want to increase our margin, employee growth. What they mean is they're going to fire employees. That might have a low discount rate. Increasing the sales. You think you're going to increase the price? Maybe if there are only two companies in the industry, you might increase the price. But if you start increasing the price, there's another company that's going to come in and take over, and you're going to lose. You're going to have negative synergies. I guarantee it. Okay. So the exercise I go through with people in the class, and we'll open the Excel, is the exercise I go through is I take an old real case, which never got complete. So this company named Exelon wanted to buy this company named NRG. They didn't. NRG still exists. The merger didn't go through. They offered a premium of 37% on the target company, NRG. So NRG's stock price was 22. It had 26.264 million shares. That's their market cap. You multiply those two things together. I know it's obvious to most of you. And when they were going to do this, they were going to give the people from NRG were going to get this premium because of the exchange ratio. They were going to get relatively more shares of Exelon than Exelon shares. And they estimated annual savings. It looks like it's they put the O&M together, and that's so simplistic. It was mind-boggling, really. You put the O&M together of this company and that company, and you take 3 or 5% of the operation and maintenance cost, and then they said they have to spend a little to achieve it. And if you took this and assumed that it was a perpetuity, it didn't grow, the savings never grew, and they were the same. I think at about it's the discount rate was, I can't remember what it was. Then you got the answer. Okay, so I used that as a way to kind of start this. So I have a file, and this file I'm going to give you, even though it's the people in my class kind of made this. I'm going to, the first thing I did, I put some different sections. Now, what I'm going to do is press Control C, I think. And if I run this table of contents, kind of, I put some of these silly kind of section headings, really. So I put one. So we're going to, we're going to first look at the ROIC and understand what the ROIC is. And I'll use Malaysia Telecom to do that. And then we'll talk a little bit about standard valuation. Standard valuation and when you see a PE ratio that's high or low, or an EV to Ebitda ratio that's high or low, how you should think about it. And there's a big theme here. And then I'm going to go through the economic value of an M&A with some synergy analysis, just using that little thing before. And then we'll do a DCF analysis of the synergies. And don't you worry, this time I'm not going to get all obsessed with I'm not going to get obsessed with Excel. Okay, I'm only half an hour into this. Okay, this video is going to be a long one, I think. And then we'll go through some accretion and dilution. And this is a easy thing to criticize. We'll call it feeding the monster, but it's not that bad. I shouldn't say that. We should have an open mind about everything and be creative about everything. And then we're going to work through the LBO analysis. And when we work through the LBO analysis, we're not going to say that we're really going to do an LBO. We're going to use an LBO framework to back into the cost and see how really easy that is. That's one of the easiest things to do. It totally depends on this EV to EBITDA ratio, what you enter at, and it depends on the synergies and premiums, and this accretion and dilution analysis can also have some synergies, and it depends on premiums. And then we'll go to a DCF model. And when we go to the DCF model, for once, I'm not going to take you through the modeling too much, a little tiny bit. Once we get that, we're going to compute a valuation, and we're going to put different different terminal values, really, and really talk about the for me the key thing there. And then for once, I'm going to talk a little bit about cost of capital. Okay, and the way I just made that table of contents was I just opened the generic macros. So here's our first thing to talk about. When in oh no. If you look at what I call this famous McKinsey book that I love to criticize more than anything, and I just messed up everything, didn't I? Okay. In this famous kind of McKinsey book, all they talk about is return on invested capital. Now, when we did our little in our little analysis, oh God, I better do a little bit of a thing here, and I think I put it in column B. I don't need a sum column, and I'll just put two things here. Sorry about that. Okay, I actually think more and more, and I should have even done one column at the top, and I guess you know what happened just now is, oh, I didn't put anything. That's fine. And here I showed in the class we spend a lot of time, and if you have forgotten about this wonderful file called read PDF to Excel, I hope you don't, because all I try to do there is I try to come up, and I haven't changed this for so long, but I tried to come up with a way to easily read the data in. So we read the data in for this telecom company, and we read the profit and loss statement and the balance sheet. That's all we need. And once we have the profit and loss statement and the balance sheet, the reason, again, now I need to keep giving you ideas, I hope. Okay. And the big idea about the return on invested capital, you can talk about all this finance theory crap and everything else, but it tries to isolate, it tries to take out all of the effects of financing and BS. It tries to focus on what your company is really doing. So you go down to the after you put the depreciation, you go down to the net operating cost. And oh, look, they had a negative here in 2018. If they had a negative like this, you'd probably want to take out some kind of impairment costs out of here. So you have to make a little bit of a judgment about what's an ongoing cost. By the way, if they have an impairment, there's a big problem because that impairment's going to lower the invested capital in the next year. So these ratios are not perfect, but we want to just keep focusing, keep our eye on a return on invested capital, because you want to make more return than your cost of capital. And then you can multiply it by 1 minus the tax rate. I'm going to press F2. Who knows if this tax, if you use the actual tax rate, you try to read these stupid books, and I tried to come up with bureaucratic rules. Oh, I hate the bureaucratic rules. Put your own tax rate in if it's crazy. Don't say it has to be done this way or that way. I put the kind of statutory incremental tax rate, and then you ignore everything down below. And then you go to the balance sheet, and you understand the balance sheet has to balance. And if the balance sheet's going to balance, everything we're going to have on the balance sheet, everything we have on the balance sheet is either related to the core business or not the core business. How's that? And you can start with the capital side. And I put it here. We can start with the capital side, and we can go down and see, well, how much where's our here's our share capital. Oh, I didn't even fix any of this. Here's our share capital. That's okay. And we go finally down to the end, and we just find our, excuse me, I'm pressing Shift Control E for this. We can go to our, and that didn't work. It's got a data table in here somewhere. Okay, oh shoot. We can put a little 1 in for everything that's invested capital, or a negative 1. How about I do this? Shift Control. Okay, let's get rid of those. So a one means it's a one means it's associated with capital, and we can add up the debt and equity and then go down to the other side and subtract things like investments at fair value, through profit and loss, all this crap, and we take out the cash, because if we have a whole bunch of cash piled up, we don't want to do that. And why didn't I even in this one? So I don't, I'm not, oh no, well now I'm getting frustrated. I put some handmade shortcuts in that generic macro. Shift Control C is a good one. And now we can see what's a positive and a negative and all this stuff. And if our borrowings, we put that's all the capital invested. But the reason I did that, the cash just a minute ago, where is our cash? Down here, so somewhere, cash balances, that didn't go up that much. But this might be billions for like Apple. It used to be billions before they got a tax break that allowed them to dividend it out and all that stuff. Okay, that's not related to the core business if it's a gigantic cash balance. And so you just take it away. You could be fancy and take half of it away or some idiotic thing like that. But the trade payables and all that, that is related to the business, so you don't do anything with that. So you start with the capital, take away everything that's not related on the balance sheet, you take it away and you add extra borrowings and all of that on this one. Or you could start with the plant and equipment. Start with the intangible assets. There's a debate what you should do with this one. I think you would include that. You include the receivables and inventories and all that stuff, and then you put a -1 on some of the liabilities and the customer deposits that are related to the core business. You could call this the direct method or something like that. And then when you get all the way down, oops, it should exactly equal it. I'm just gonna pretend it was exactly equal. Okay. And then you can get the return on invested capital. You see that it's not that simple a calculation. That was a little bit embarrassing. I'll fix that later on the file before we get it. Now, I hope I didn't mess something up by having it on two sheets. Okay. Then here's the next thing I say. Before we get into this valuation with what have you, the synergy valuation and all that. Let's just understand a couple of really. Oh, this is going so slowly. There's something when the video on it goes really slowly. Let's pretend that we had a company, and this company is some nice lady selling me coffee in Thailand. And she has a little bit of a cart, but that cart is really pretty cheap. And she doesn't pay any taxes, and that's her business. And she gets some Ebitda, she gets some money, but she doesn't make any capex in her business. She sells everything immediately. There's no working capital in her business. She doesn't have any debt, or as soon as she gets any money, she gives it to her child who's trying to get through school. So she's got no interest or taxes, and that's it. And then she could be listed on the exchange. And if she's listed on the exchange, we could pretend that her listing would be 1,000. But if we computed her enterprise value, the enterprise value would be the same as the market capitalization, because she has no debt or no tax or no nothing. It's very nice and simple. And if we computed from this very simple case, maybe it's too obvious, her PE ratio would be 10, and her EV to EBITDA ratio would also be 10. And if you computed her return on equity, if you just pretended her equity capital, this is just an input. Maybe I'll even do it here. I'll even do my coloring sheet. Okay. which is taking too long, but I don't care really that much. Okay, so now it looks a little better. We can see what's an input. We just put an input for our equity capital, but that's the same as our invested capital, and we're getting a nice return on both of that. I'd have to think about what her invested capital would be if she had no. She has to have some working capital. She has to buy some inventory. Okay, that's her investment. Okay, she has to buy some coffee stuff or something. All right, to sell. So that's everything's the same. That's the point. Now, when you get the when you move to the when you add some depreciation and some capital expenditures, suddenly everything changes. Now our EBIT is different than our EBITDA. And when our EBIT is different, we have no taxes, no interest, that same market capital is the same. I'm sorry, it's the same as the enterprise value, but the PE ratio is different because we have less income. We're taking our value divided by the lower income. So we get a difference. Our depreciation causes a difference between our PE and our EV to EBITDA, and it doesn't cause a difference here in the in the ROIC yet. I think that's correct. But and then we put in taxes, okay, and then we get a yet lower income, and we get a yet bigger difference between the EV to EBITDA and the PE ratio. And that's what I'm trying to say. Now, whenever I have a class like this, and I debate with myself, is it worth it? Is it really worth it to go through this? I'll always take people through a 300-year model, and I'll put a little case with return on invested capital going, or no, return on return on investment going up or down, and I'll start with a case where everything's flat, and then we move a case to when things increase or decrease, and the growth increases or decreases, and we always go through and prove out this formula that the from the from a couple of different equations. It's so easy. It's so easy. You can just say, first of all, you say that you use this equation that the growth rate is ROE times 1 minus dividend payout ratio, which is so stupid to do it like that. Because that's not the way it works. It's the dividend payout ratio. You back from the growth rate. So you just back out dividend payout is 1 minus G over ROE. And then you say, well, we know that if this is Gordon who did this, he didn't invent this, that's for sure. Because I know Merton Miller was using this way before Gordon, and he just said, I can just take the value of a company, and that's just the dividend divided by the cost of capital minus the growth rate. And that's because the dividend is cash. But we can convert that dividend to earnings by saying the dividend is the earnings times the payout ratio, and then we use this payout ratio, and then we derive the value driver formula. And then I did this kind of badly because I think shouldn't these outputs have been moved up here? Okay, so the real lesson here, and this is, I'm hoping that the nice people in my class, I'm giving them something to really, really review here, and the coloring is not going to be very good. Okay, and we put an index number, and of course, if you, this is for the ROI going up and down, and of course, if you wanted to make a little scenario analysis, and the real key again is not wasting time on all of these little gimmicks that I always love so much. And I used to think teaching a class was about gimmicks like this. I really did, and they were horrible. Should have got horrible ratings for everything, but people were nice in places like Czech Republic where I used to be able to have my classes. Now they're all online. It's so sad. Okay, and that now, so if the return is increasing, the PE ratio is high and the price to book ratio is high. If the return on on investment is decreasing, then the PE ratio goes really down and the price to book ratio. This, if you don't reflect, if you're trying to compare different companies and the different companies have different increase or decreases in return, and the same goes for the growth rate, although I didn't finish this here. If you don't adjust for changes in both growth and returns when you're doing an analysis and comparing EV to Ebitda ratios or things like that, it's a disaster. And I have to skip around, and I'm not going to apologize a little bit for skipping around because I'm really trying to make my thoughts on all of this just a little bit more structured. But the typical thing in a M&A analysis is you got something like this ridiculous. This is so ridiculous, it's mind-boggling. Look at the difference in the dates of these transactions. 2001, 2007, this is obviously old, 2002, 2009, comparing different transactions and then getting aggregate value, which is enterprise value, to EBITDA. And you get dramatic differences. Or, and this is the same kind of thing, this is what people love to do, but if you don't, and this is, it's highly confidential. If you compute these EV to EBITDAs and try to say, I'm going to apply this to this company, and this company had a really low EBITDA, and we know it's going to increase. And if you don't put the ROIC and put any comments about what you think is going to happen to the ROIC or ROE growth, if it's priced to earnings, or the overall growth in the not only the ROIC growth, but the overall growth in cash flow, you haven't done anything. It's just totally worthless. I know that young investment bankers, that's all what they have to do at first. I better get back to where I was, okay? Because where I was here was we were starting to talk about this little case study, okay? Now I'm going to. Okay, so here's what I want you to do. Can you be quiet? I'm making a video. Okay, so I'm sorry, everybody who's listening, for the interruption I just had. Okay, and here is how this thing works. Now, when we just did the PE ratio from a simple kind of analysis, there are a lot of differences when you would compute the EV to EBITDA ratio. Okay, so what I've got here is a very similar kind of example. And in this similar example, and I'm sorry I'm a little confused. I've got so many people sitting next to me. Oh my gosh. And we do the same sort of thing. Uh-oh, I have a really wide thing. We go for a very, very long period, but this time our opening and our closing balance, that we compute a ratio of net plant to depreciation, and for the invested capital balance, we include a plant balance that accounts for the depreciation and it accounts for the working capital, and you finally get the ultimate product. And you remember, I hope, that basically there's nothing other than EBITDA, working capital, capex. These are all the things that define the cash flows. You can go through this much more quickly, much more slowly. Of course, you're going to get this file on the website. And then when you get this file on the website, you can see how the valuation, how the valuation works. Excuse me for not being able to get some words out of my mouth just now, but you can see how it works. Oh no, there's a loud motorbike. And here's the real result of this analysis. The real result is, number one, just like we did before, that the valuation, if you have the projected ROIC going up instead of down, and I put a little interpolate function here, okay, if we have the ROIC going up, of course, we're going to have a dramatically much higher ROIC. If the ROIC goes down, we have a much lower ROIC. So when you all make your calculations, and this is what's really driving me crazy, if you wanted to do a good comparable analysis, unless every company in the industry is in exactly the same kind of time period and has exactly the same kind of profile, which by definition they don't. Companies with older assets tend to have larger ROIs that are going to come down. With newer assets, they have the ROIs that are going to go up. You need to make some adjustments to this and look at the dramatic difference. So now I'm going to put the ROIC in there and make it equal, okay? And maybe you want to do that, or maybe you want to understand where you are. And then, of course, the growth rate has the same sort of effect. As long as you're, as long as you're earning more than the cost of capital, if you put a lower growth rate in, excuse me, I don't have any disease when I'm coughing. So here is the key theme for this. The key theme for this, and maybe I'll put a 7% cost of capital. Let's get the Ebitda up a little bit. Okay, if you put a 20-year life or a 10-year life, you're going to get a very, very different answer. How could you possibly, when you make a comparative analysis, compare companies that have excuse me, a different depreciation rate? Now, perhaps if you're saying, we're in the same industry, they should have about the same depreciation rate. Okay. But then you might want to check the tax rate, the typical tax rate of a company. If we put back in the U.S., for example, with state taxes, companies might have a 40% tax rate. Okay, I think maybe I should put it to automatic accept data tables. When you have a tax rate of, let's say, 25%, then I hope this changed pretty dramatically. Let's put a 40% tax rate, then we have 10, 20%. Now, there was recently in the US a big change in the tax law because of whatever. We cannot, if we're comparing things in historic EV to EBITDA ratios, you can't compare those without understanding what the tax rate is. That same problem does not exist for the PE ratios. And that is because of all this thing. When we did this kind of thing, well, I should have kept our PE ratio flat, really. And then I should have looked at the relative difference between the PE and the EV to EBITDA ratio. We saw it change because of depreciation, change because of taxes. It would change even because of the financing. And maybe you could make some kind of argument it changes because of the cost of capital, although what you're really, really doing here is you say, I don't care about the cost of capital, I'm not interested in the cost of capital. If you knew what the projected ROIC was, the tax rate, remember how I did the terminal value, although I do remember, I shouldn't have said that, that was an idiotic thing to say. If we do this one, PV, okay, so this is the end of part one. This is the end of part one, and before we've talked about any of the real different valuation methods. And before we've gone into the details of the ways we can compute the benefits and costs of a M&A transaction, before we've done any of this, we've had some discussion on what really drives these valuation ratios. And in the old days, I would always want to get straight, let's get straight into these complicated methods. Let's get straight into the fancy way we can compute accretion and dilution. Let's make an LBO analysis to start showing off how fancy we are. Or let's talk about some complicated, fancy structures, different debt structures with mezzanine debt or earn-out provisions or something like this in an M&A, when the real first thing you should always be doing, at least I believe, is really understanding where the value is coming from. So that's the end of part one, and now let's move to part two of this video.